Hello, everyone. Welcome to today's session. I'm just gonna before we start, we'll just give it a minute or so and let people filter in. So just bear with us for a second. All right, I think we can take it away. So welcome to today's session. We're going to be talking about bonds. So the title of this webinar is Why and How to Use Bonds in Your Portfolio. Let me just put the slides on here. So yeah, this is the title. A little bit about your speakers here today. So you joined myself. I'm just giving a little intro, but the main speakers today will be Althea Spinozzi. There's a description here. She's joined Saxo Bank in 2017, and most importantly, she's head of our fixed income strategy. Also, we have Nikolai. He's more head of product, a little bit more technical in nature. He's also been at Saxo Bank since 2019, so we've got a lot of experience here. A couple of points before I just talk about the presentation. So firstly, there are questions and answers. So we'll get to Q&A at the end. The questions are open. You can put those into the box whenever you wish. We'll try and pick them up along the way where appropriate. And if not, we'll post them at the end and we'll have some time at the end. Also, the handouts, which you're looking at now and that Althea is going to run through in a second, they're available for download. So if you pop yourself into the handout section, I believe it's on the right-hand side of your desktop and probably at the bottom of your mobile, then you'll be able to download the PDF and review these in your own time. One other point on webinars, and this is the same with all our webinars at Saxo. I mean, the link with which you joined today, you can use the same link to rewatch the webinar at any point in time. So if you really wish to review this content in the future, just use that same link you used to join and you can watch it on demand. So that's really the intro. Just a quick look at the agenda. So Althea is going to go through these comments. Again, she's our head of fixed income strategy. And then just before Q&A, we'll get to Nikolai, who's going to give you a bit more of a platform demo and talk you through, how you might do this practically. One thing importantly before we start is just to show you the disclaimer. I won't read this out. It's a standard disclaimer. We put this on screen before all our webinars, but just take note that this is line of education and informational purposes only, and it should not be seen as a recommendation or offer or solicitation to buy or sell any securities. Okay, I think that's enough for me. You can see our hosts here, and we'll go straight to Althea.
Thank you very much, Luke. I hope you hear me right, but I wanted to start this webinar with a short intro to bonds because maybe not all of you are familiar with fixed income products. So what is a bond in essence? A bond is a debt instrument issued by an institutional counterpart that is looking to raise debt to finance existing operation. So what happens, an investors would normally lend a lump sum of money to a corporation for a certain number of years. And throughout that time, that corporation would pay a semi-annual or annual coupon as agreed from issuance. And at the end of that debt agreement, the investors will get the notional back. So why is very interesting to invest in these products at the moment? Well, for two reasons. Because interest rates are still the highest that we've seen in the past 25 years. And second, what makes bonds very appealing at this point in time is that it doesn't matter if where the market is going to go tomorrow, in 1 year or 2 years. An investor buying a bond today is going to secure a yield to maturity. And with yield, what we mean is an annualized return of that bond, which will not change throughout the life of the bond until the notional gets paid back. So let's compare bonds versus stocks. So bonds, the favorable part of bonds is that they are posing a much lower risk than stocks, and they are less responsive to market fluctuations, which can be good or can be bad. For example, if there is a lot of volatility, normally bonds are less responsive to volatility compared to stocks. So maybe when stocks drop around 30%, and we've seen that later would happen in 2022, bonds are not going to drop that much. On the downside, bonds have much lower earning potential because they are also less risky. When we look at the capital structure of a company, there is debt before equity. That means that in case of default, debt creditors are going to be repaid before equity holders. So bonds are fantastic. They are much safer than stocks. And when we look at sovereign bonds, we are even referring to safe haven because we assume that the notional will always be repaid at maturity, but they still provide some risk to one portfolio. And two out of these six risks, it's something that we have all witnessed throughout the past 2 years and a half, which is interest rate risk and inflation risk. So what does that mean? Inflation risk is simply eroding the value of your bond portfolio, because let's say that you buy a bond at 5% and inflation is at 6%, then your real return will be on minus 1%. And interest rate risk, if interest rates rise and a central bank is going to hike interest rates exactly as we have seen in 2022 and 2023, your bond holdings are going to lose value. Why? Because if interest rates are up, the price, the valuation of your bond portfolio is going to go down. Then there is another set of risk, but I think that it's very important right now because the economy is decelerating, also to highlight rating downgrades risk and credit default risk, because when there is good macroeconomic backdrop, normally these are not a huge part of the problems that the bond investors will face. But when the economy is decelerating, that's when corporates starts to struggle, recording less profits, and that might mean that they might face the risk of downgrades. And if we are looking at the lower rated credits, junk bonds, then they might even face a default. Let's look at markets. And I want to start by looking at the bond performance. Here it's on the left-hand side, US dollar bond performance, and on the right-hand side, euro bond performance from 2019 and 2024. And why do I want to look at that? Because the past couple of years have been very interesting. We had exceptionally high inflation. Central banks had to hike interest rates very aggressively, and that resulted in widespread losses concentrated throughout 2021 and 2022. The main takeaway of these two charts is that the bonds, basically, if we look at all bonds type, so US treasuries or European sovereigns, junk bonds, investments, and investment grade corporate bonds, emerging market, they have lost value in 2021 and 2022, and they started to recover in 2023. Why? Because despite central banks in the first half of 2023 were still hiking interest rates, the new bonds that were issued throughout 2022 were carrying a higher coupon, and a higher coupon serves as a buffer against devaluation of the bond, and it has helped with the performance of 2023. Another very important takeaway here is that the only investment that the type of bonds that outperforms others, such as sovereign bonds, is junk bonds. Why? Because of the same thing that I was telling you about. Junk bonds, because they're more risky, they pay a higher yield, and that higher yield and coupon serves as a buffer against rising interest rates. And that's why in both euro and US dollar bonds, you see that junk bonds have been the best performers in 2022 and 2023. Then I think it's very important to make a comparison between the stock market and the bond market and how they perform throughout the same period that we have seen before. And as you can see in 2022, well, it wasn't a very good year for stock markets either across US and Europe as well. But what is very interesting to see is that in 2022, if we look, for example, at the US market, we've seen the Nasdaq dropping more than 30%, and the Standard & Poor dropping almost 20%. But US Treasuries, despite they also lost because the Federal Reserve was hiking rates, well, they didn't drop that much. They dropped around 12%. So this is just a way to show you that bonds are a better investment to retain value over time and over volatility than stocks. So let's look now at the macro picture. So the question that I'm asking myself is, are markets ahead of themselves? Well, the reason why I want to ask that question is that now the ECB, the Federal Reserve, they have all started to cut interest rates. And the Federal Reserve in September started actually with a jumbo rate cut of 50 basis points. And what happens is that the market has been pricing an aggressive interest rate cutting cycle. In this chart on the left-hand side, you see in blue the expected Fed fund rate according to markets today. And in gray is the expected ECB deposit rate from today until 2027. And what you can see is that the markets right now are basically expecting the Fed fund rate to drop from 5% to 3% already by the end of 2025, and the ECB deposit rate to drop from 3.5% to basically below actually 2% in mid 2025. But we don't have a dot plot in Europe, but we can compare what market is pricing with the dot plot that publishes the Federal Reserve. And the Federal Reserve is telling us that the interest rate cutting cycle shouldn't be as aggressive as markets are expecting. They see the long-term neutral rate, and I'm talking about the neutral rate that will be here from 3 years on into the future, is estimated to be around 3%. And the Fed expect to cut down to 3.4% by 2025, while market thinks that the Fed would cut down to 3%. And this mismatch creates risk and opportunities for bondholders, because the current picture is just telling us that maybe valuations are too rich in bond market, and it's very critical to find the right spot where to invest to in order not to lose money within a certain amount of uncertainties concerning monetary policies and also inflation. So, are markets ahead of themselves? Well, as you can see, yields have been dropping already quite considerably, from 5% in October 2023, when we look at US Treasuries, to down 3.75% for the 10-year Treasuries, and the 2 years has also collapsed from 5% to basically 3.6%. The same we are seeing in Europe, with the 2-year shots having fallen from 3.4% more or less last year to down to 2%, and the 10-year bond yields having dropped from 3% to 2% now. So the big question is, are these yields appealing here and now? Does it make sense to buy bonds today that yields have tumbled so much? And my answer to that question is, well, it really depends what you're looking at and what is your goal. For example, if you are a long-term income investors that are looking for a stable income to come regularly into your portfolio, maybe you want to go long term, you want to look at long-term bonds that they carry a very chunky coupons, because you want to secure that coupons in case in the future yields and coupons are going to be decreasing. However, this is going to add to your portfolio duration risk, and as we have seen in the slides before, yields have collapsed dramatically in the past year. If instead you're looking to for an optimal risk and reward, I want to show you this chart, which I think it's very important, and it's a good way to understand which kind of risk you want to take. The main takeaway of this table is that short-term sovereign bonds in whatever geography you're looking, US, Germany, UK, Italy, and France, they are a safe bet where to park money. Why? Because if yields are going to rise by 100 basis points, so for example, in the United States, the 2-year is at 3.6%. If in 1 year time, the 2-year US Treasuries goes to 4.6%, you will still be making 2.7%. And this is only if you sell that bond in 1 year time. Otherwise, you can keep it until maturity, and you would just secure a yield of 3.6 every year. And why this is possible? Because coupons are very chunky, and they are providing a buffer, especially when duration is very short. This is different when you start to take some duration risk. And when I look at the 10-year tenors across geography, it's not a bad proposition. Why? Because, for example, the 10-year US Treasuries today is trading around 3.7%. If yields drop by 100 basis points in 1 year time, then I will make 11%. But if yields rise by 100 basis points, I will lose just 3.3%. So basically, the 10 years right now, what it gives to a diversified portfolio is a sort of diversification tool, because if let's assume there is another spike of inflation and the Federal Reserve would need to continue to hike interest rates and not cutting them, well, that's when you will have still yields rising. But if there is a very aggressive interest rate cutting cycle because of a crisis that is coming along that we cannot foresee right now, well, these bonds are going to give you a very nice protection to your portfolio. When I look at extremely long durations, and here I list the 30-year tenors for each geography, well, that's more a directional bet, because if I hold the security for 1 year and yields move by 100 basis points, I'm going to make or lose 23% or 11%. So that's a more directional bet that is betting on a recession, on a crisis that if it doesn't come, it might it might provide quite big losses to your portfolio. I just want, before moving on the slide, there is a mistake in this table. I've just seen it right now. It's for the France 10-year bond. And as you can see in my risk reward analysis, I say if yields drop by 100 basis points, it goes to minus 11%. That's wrong. It should be 11%, that with a plus and not with a minus. And I apologize for the mistake. So the question now that we looked at risk and reward and tenors, like where to position in a yield curve. Well, in order to take a decision, we have also to shape our understanding of the macroeconomic situation in the US and also in Europe. Why? Because this economic cycle is very different from what we have been accustomed to since the global financial crisis until today. And I believe, but this is my personal belief, that we are in a situation where maybe central banks are not able to cut rates significantly as they did pre-COVID. The reason being is that there is in the economy, there are some pockets such as services inflation that remains very elevated. Wages remain elevated. The labor market, it's not anymore tight, but is humming along, is going quite well. And when I look in this case at the US economy, what do I see? That unemployment has risen, and it has risen to 4.2%. But when I look at the averages between 2010 and 2020, I see that unemployment within that period of time was above 6% on average. And but this comes along with core PCE. PCE is like CPI, is an inflation measure, but it's a favorite kind of inflation measure from the Federal Reserve that they look at and shapes monetary policies. While core PCE is at 2.6% now, while on average between 2010 and 2020, it was at 1.6%. And when I look at the GDP, so I've been talking about a certain deceleration of the economic activity. Well, we are not seeing that yet in the US because GDP for year on year, it's still at 3%, which is well above where we have seen in 2010 and 2020. So what does this economic situation is hinting to? Is hinting to the fact that probably what we are witnessing right now is a deceleration of the economic activity that is impacting certain parts of the economy, which are more vulnerable to high interest rates. And I want to remind everybody that the yield curve has been until today inverted. That means that those cash-strapped companies and individuals that had to rely on financing in the front part of the yield curve have been paying the highest interest rates on market. The rest of the economy, instead, that is pricing on long-term rates, so 10 and 30 years, and I'm thinking about very big companies like Apple, Amazon, or mortgages, which are pricing for 30 years. They have been benefiting from lower rates compared to the short part of the yield curve. So what's happening now that the Federal Reserve is trying to steepen the yield curve, is cutting rates on the front part of the yield curve, and is providing some sort of relief to the weakest part of the economy. But by doing so, is also providing some sort of reacceleration for the rest of the economy that has been going quite fine for the past 2 years when the Federal Reserve was hiking rates. So a risk that markets are not pricing in today is the risk of a reacceleration of the economy, a rise of inflation, not a massive rise like we have seen post-COVID, but something like remaining between 3 and 3.5%. And that is a risk for bond investors, because it means that an aggressive interest rate cutting cycle might not be delivered, and the steepening of the yield curve will be felt with the long part of the yield curve shifting higher, which is dangerous not only for bondholders but also for stockholders, because at that point it would be painful for stocks as well. So when I look at the ECB, obviously, and at the European economy, the situation is very different from that of the United States. But there is two things that I think it's important to acknowledge. The first thing is that the unemployment rate, which is the gray line that you see in the left hand, in the chart on the left hand side, is basically the lowest on record for the Eurozone. And wages, it's not in this chart, are still elevated. And while it's true that the European economy has been stagnating in the past couple of years, there is some sort of recovery. The recovery is by all means below what the market was expecting, but it's still a recovery, which is happening in a context where unemployment is low and core inflation is still around 3%. So I think that also in this case, the ECB obviously has more room to cut rates when we look at the weakness of the economy. But when we look at inflation, which is, by the way, the sole mandate of the ECB, it remains quite sticky. So it will push policymakers to remain quite careful and probably not cutting rates down below 2% within the 12 months as the market is expecting right now. So now that we covered the macro part, I want to enter in a more practical part where I talk about risk and opportunities out there. And I'm making some specific examples, and I'm showing you also a list of some specific ETFs, bond ETFs. But I want to be clear that this is not a recommendation. This is just a brainstorming and an inspiration kind of talk that I'm making in order to provide you with some ideas on how to approach these complex investment investment environment. So what are the risks that bond investors are facing right now? Monetary policy surprises, and that the only way that monetary policy can be surprising right now is if the ECB or the Federal Reserve is not delivering on interest rate cuts. Just to bear in mind, the Fed fund rate right now it's at 5%, and markets are pricing the Fed fund rate to drop to 3% by October 2025. That's a very aggressive interest rate cutting cycle, which only happened during times of crisis. So the global financial crisis, the dot-com crisis, and the 1998 Russian default, and the long-term capital management crisis. So at this point of time, if we don't have such of a crisis or a shock to the system, the only way that this can go is that central banks are not going to match market expectations. The other risk that we might be facing is that inflationary pressures might surprise on the upside, that might remain sticky around 3% or resurface again above 3%. And then the other risk is a credit event, which right now it's very hard to foresee because nobody has been foreseeing also the previous crisis. But they provide bond markets also provide opportunities. The first opportunity is to park cash. And this is what I've been saying when I was showing you the risk and reward table before. The 2-year tenor, it's an exceptional good instrument to park cash across geographies. Then the other opportunity is again to behave like investors have been behaving in 2022 and 2023. So trying to create a buffer against inflation and monetary policy surprises. And the other opportunity is emerging market bonds, and I'm going to explain why later. So park cash, we already talked about the 2 years, so I don't want to repeat myself. I want just to make a point of bond ETFs or money market funds. The main difference between the two is that money market funds do not gain from capital appreciation. So they are a great tool to gain when the Federal Reserve or central banks are going to hike interest rates, because you are going to receive the highest interest rate without losing from your bonds valuation. But when interest rates are being cut, you are losing upside from capital appreciation if you are invested in money market funds. The best way to capitalize also on rate cuts from a bond valuation kind of perspective is to invest in ETFs that have exposure to the short part of the yield curve. I'm talking to 0 to 3 years kind of maturities. And this is in this chart, I'm showing you the total return for the past 12 months, 3 years, 5 years, and the expense ratio, because money market funds are also more expensive than traditional ETFs. And what you can see is that the first two are money market funds. There are two popular money market funds: the Global Saxo Funds, US Treasury Liquid Reserve Fund, and the BlackRock Super Money Market Fund. They have quite of a high expense ratio. And while it's true, they had quite a valuable total return for the past 12 months and the 3 years, when we compare it with ETF, we see that in the past 12 months, they have not been performing as well as ETFs. Why? Because they haven't been gaining from capital appreciation. And also when we compare, for example, the 5-year total return, we see that money market funds have been returning around 2% per year. That it's very similar to the iShare short treasury bond ETFs. But what is good about the iShare short treasury bond ETFs is that the expense ratio, the fees of these ETFs are much lower compared to the money market funds that we have looked at. So the second opportunity, create a buffer through high yielding security. And this is what I also talked at the beginning of the presentation. If we have monetary policies or inflation surprises, it's important to secure a yield high enough that is going to create a buffer against these surprises. And how you can do that? You can do that through corporate bonds. Here it's a list of high yield and investment grade corporate bonds. I just want to say that the best way to invest in corporate bonds in general is through ETFs, because this way one can get diversification and is not committed to one name only, because committing to one name only, especially for the junk bond space, requires a lot of bottom-up analysis. If we have to compare high yield with investment grade corporate bonds, if we want to create a buffer against inflation and monetary policy surprises, then high yield corporate bonds will be a better option, just because they provide a much higher spread over their benchmark compared to investment grade corporate bonds. But another way to create a buffer against inflation and monetary policy surprises is through emerging market bonds. Why are emerging market bonds interesting right now? Well, there is a lot of emerging markets that have been already cutting rates, and this is true especially for Latin America. But there is a lot of countries that have been conservative. They've been cautious. They have not been cutting interest rates. And now they have the opportunity to cut interest rates, but they still need to maintain a cautious stance because inflation pressures are not yet out of the way. And these kind of countries are going to provide a favorable backdrop for bond investors. Why? Because rate cuts are going to support bond prices. But if there is not an aggressive rate cutting cycle versus, for example, the US or the ECB, then also their local currency will be supported, which is favorable for both local and hard currency debt. So when I look at it's quite hard to cherry pick on markets this way. But for example, a good example can be Mexico in the Americas, for the simple reason that Banxico didn't cut interest rates. They are still above 11%. Inflation is at 5%. It's still hot. So yes, Banxico has more than 500 basis points of buffer over inflation, so it can cut gradually and slowly and support bond prices, but it will not be willing to cut aggressively, because Banxico has still fear that inflation might not fall below 5%. So this is going to support also the currency. Other countries with similar situations, which are actually better because inflation has decreased to 2%, are in Asia, and that could be Malaysia and Indonesia. Here I've listed two emerging market UCITS government bonds ETFs, which can provide a good diversification in one portfolio and still gaining through the momentum that we see in emerging markets. And I think I'm done. Well, I just let Nikolai continue.
Yeah, thanks, Althea. Hand it over to you, Nikolai.
Thank you. Just trying to share my screen here and move some stuff around. You see the screen?
Yeah, we can see it. All good.
Cool. Okay. Thanks, Althea. So nice walkthrough of interest rates and also in the end about bond ETFs. So allow me to then try and give you a little demo of how you can also use trading of single bonds and not only ETFs using the Saxo platform. Now, we've been trying for the past 5 or 6 years to develop a very unique and very nice client experience for how you can trade bonds, single bond names. And it's a fully digital experience where, as we say, the intention is for you to basically just click and trade, just like you would for any other kind of cash security. And bond markets have traditionally been something of a bilateral trading experience. Usually, as an investor, you would go to your own bank and you would trade with your own bank. They would offer you a price for a specific security. So that's not what we're trying to do. We do not put our own capital at stake here. We act solely as an agent, and by doing that, or in a way, we try to leverage, the various retail exchanges out there in the world that trade bonds. There are not too many of those, and then adding our ability as Saxo Bank to get liquidity in the institutional markets, and we try and put that together to create a nice experience with good prices also from the markets to you as customers. Today we have around 5,000 bonds that you can trade in the platform. As I said, click and trade. It's a combination of government bonds and corporate bonds, so you can trade both. The majority of the bonds are either US or European, both in terms of government bonds and corporate bonds. But we do also have some emerging market bonds available in the platform. So if you are interested in trading bonds, there are a couple of ways to get to the right instrument in the platform. Let's start with the most simple one, which is basically just to use the instrument search functionality. So if you have an idea about a specific bond that could be, let's say, one of the 30 plus bonds issued by Apple, for example, and you would simply just type Apple, then it'll give you, different kind of instruments that are, trading with that Apple as an underlying. You see here there are some bonds we can also just filter on. Now, I don't want to see everything else. I only want to see bonds. And if I expand this one, I get 40 different bonds issued by Apple. So that's one way. There is maybe another example I want to show you, because Althea touched upon the interest rate risks and the risk reward when rate or yields go up and down. And one of the best ways to see that is the Austrian government bond that is more than 100 years to maturity. So if you just to show you the magnitude of that interest rate risk, if you had bought that bond in the end of 2021, it traded around par, but right now it trades at the price of 47, meaning a decrease in price of more than 50%. Obviously, that also speaks into the risk reward that Althea talked about, because our rates moving in the other direction down, then bond prices will move up, and there could obviously be a significant upside to this one. Now, let's assume we now found a bond that we want to trade. Let's maybe have a look at the another one here. I can also just look for Netherlands, and I'll take 2.5% maturing in 23. Again, the platform experience here is kind of similar to what you see for other instruments. You have a chart that shows you the development over, in this case, the last 3 months. Up here in the header, you will have the name of the bond. Our naming convention is typically so that you see the coupon and the expiry date and the currency already in the name, but you can also see it down here below the chart where we have some attributes to the bond. Up here in the header again, we're showing the current bid and ask that we are seeing from the market. And just to the right of that, we've done some calculations on what does that mean in terms of yield to maturity. So in this case, if I want to buy this bond, the offer price in the market right now is 101.83. And we calculate here that if you buy at exactly 101.83, that will correspond to an annual yield to maturity of 2.27% until 2023. This bond is listed on Euronext Amsterdam, but we might trade it on various different exchanges. Let me see if I can find a good example of that. So it could be this one, for example, which is another Dutch government bond. Well, in this case, it can trade on Milan and Amsterdam. And if you open the trade ticket, you'll see prices from both sources. It could also be the institutional market, and there you could have a third price source. But when you place the order, our order machine will also always go to whatever market we feel the price is the best, no matter what you're seeing on the screen. Just moving below the chart here in the product overview, we have some certain different data points about the bond, the issuer, which country it comes from, and down here some information about the coupon on this specific bond. In this case, it's a fixed coupon. They can also be floating or variable, and this one pays 0.5%. In coupons. Now probably need to go here to see that. So those 0.5% is paid annually by the issuer, and the next coupon date is the 15th of July. For some reason, my demo account here doesn't show me the credit ratings, but over here on the left-hand side in the product overview, we are for most bonds also showing the credit rating of the bond. We're using S&P ratings to show to our clients, and for most bonds this is available, but are obviously also a lot of bonds that are not rated by the rating agencies. There are also other ways to get to find the bond that you want to trade in, and just wanted to show you also the bond screener. So on the top left side, you will have also a screener tab. That is basically a filtering or search functionality that you can use to get to the right bonds. If you don't have, on the top of your head, a specific bond that you have heard about or have been recommended that you want to find and trade in our platform. So just as for any other instrument here, you can use the filtering method in the screener. In this case, it's already pre-selected to bonds. And when you select bonds in the screener, it'll give you different kinds of variables that you can filter on. So you can filter on the issuer type. Let's say I want to now explore corporate bonds only, and then it'll filter away all the government bonds. Althea touched upon the possibility of having, a high or a chunky coupon. Okay, I can also filter on that, say I want at least, let's say between 4 and 6% in the coupon in the bond that I'm looking for. And to avoid the interest rate risk that we also touched upon a couple of times, maybe I don't want to get to maybe 20 or 30 years. So let's say I want only to go up to between 4 and 7 years. And again, we'll be filtering through all of our 5,000 instruments, coming up with the ones that results in, based on the criteria that you've put up here. It might also be a consideration to look at the currency, because obviously if I am living in a country where euro is my main currency, and I find an Apple bond denominated in US dollars, I introduce also a currency risk to my investment. So maybe I don't want to do that. I will only select euro. Now, based on the criteria I have selected so far, it returns 144 bonds. So let's see if we can find one and have a more detailed look at that one. Shows this one, buyer 4.25%, maturing in 2029. So let's say I was interested in trading in that. I will open the trade ticket, and just this again is very similar to other kind of instruments, but there is one unique feature that you may want to be have a look at, and that is the concept of accrued interest. So when you trade bonds, you pay accrued interest to the previous owner of the bond, basically. So you can say if the bond pays out a coupon on an annual basis, and I buy the bond from another holder halfway through the year, then I would have to pay that proportional part of the next coupon back to the previous owner. In that case, around 50%. But you can see the amount that you're being charged in accrued interest down here in the trade ticket, and the point here being obviously that if you hold this bond past the next coupon payment, you will get the full coupon that is paid because you've already paid the previous investor's part when you bought the bond. But just going through this, if I want to buy 100,000 euros in this case at 105.35, that corresponds obviously to a market value of 105,000 euros, but then I have to add the 454 euros in accrued interest. I think that's it basically. You can also store these the screeners that you come up with as watch lists, and the watch list and the screener itself also has a lot of bond related information in there. So for example, you can filter or sort on yield to maturity. You also have the coupon, the maturity dates, etc. So everything is kind of custom to the instrument that you're looking at, and you can also manage the columns of the screener where you will find maybe some more very bond specific columns. Like as I said, I mentioned some of them, like mid yield and coupon obviously is only relevant to the bond instruments when you use the screener for that. I think that was it for the platform walkthrough. Is there any questions that we may want to take up? I think the last one maybe I can take first because that is related to the walkthrough, I guess. It says if does the bid ask include the bid ask price include accrued interest, but no, it doesn't. So so the bonds trade. In our platform, they trade on what they call clean price, meaning it is the price that you pay without the accrued interest. But then, in addition to that, as I mentioned, you will add the accrued interest to get to that full amount that you need to pay. But the prices that you see are without the accrued interest.
There's another one there, Nikolai. I think this is an easy one. Is it possible to seek bonds by ISIN? Can you look them up in that method?
Yes, you can. So in the instrument search field, I searched for, let's say, Austria before, but if you have a specific ISIN that I don't know anyone by heart, unfortunately, but you can just punch in the ISIN there and you will get that specific bond.
Cool. I think we got one more platform related question. Oops, not that one. I'll come back to that one. So yeah, it's about the screener and a maximum number listed. I think the screener shows 250 at a time, if I'm not right. Yeah.
Yes, that's correct.
Yeah. Yeah, so you'll see 250 results, and you can obviously filter that down using the different filters available. Okay.
Yep,
yeah,
true.
cool. Right, so we've got some questions I think we should direct to Althea. And can you see the questions there, Althea? I don't know if you want to pick some that you think are relevant, because we've got quite a few coming through.
I apologize. I was on mute. So I wanted maybe to start. There is actually a very easy one. if when interest rates start to rise again, which end of the yield curve it is best to be invested, long or short? The easy answer to that is short, because as we have seen, the short part of the yield curve is basically almost impossible to lose money. To make an example, the 2-year US Treasuries yield needs to rise above 7% before within 1 year before providing a loss. And if the 2-year US Treasury yields rises above 7%, that means that the Federal Reserve has to hike rates again by 200 basis points, so that inflation might rise again above 5%, because normally interest rates, when they want to be restrictive, they have to be set above the inflation rate. So that's a scenario that I don't see it happening. I see definitely sticky inflation, but not spiking inflation. And the short part of the yield curve is providing a good risk and reward for that reason. Another question that I thought it was quite interesting, it was regarding how to protect against the devaluation of the US dollar. If there is any ETF. I won't comment on ETF specifically, because I would need basically to screen for them. But what I wanted to say is that there are several ways that you can protect against a devaluation. And that would be by investing in bonds from countries where that risk is not going to happen. It can be like, for example, in Swiss franc bonds or euro bonds, if you believe that the euro would not devalue. Or otherwise, again, we can go back to emerging markets, because if the US dollar devalues, obviously that's very good and positive for emerging markets, which the local currency would strengthen against the dollar. And then obviously it's not bond related, but if there is a US dollar devaluation, think about precious metal, gold.
Althea, there is a question on from Greg on when you say you lose money on the long end of the yield curve. This is only if you not hold to maturity. However, if you buy a 15-year bond at an 11% yield and hold it to maturity,
no,
then you will not lose, right?
You don't lose money unless there is a default, right? Because I imagine like a long-term bonds, 11%. I don't think even that Pemex at the moment is paying 10%. So I would assume that that's a bond, it's a high yield bond, and the problem that investors would incur is a default.
There was also a question about shorting bonds. So basically, when you talk about individual bonds, then in Saxo, we don't offer that possibility. So you can only buy bonds, and then you can sell bonds that you have in your portfolio. But I guess if the concept of shorting bonds is possible using other instruments, I suppose either futures or there may be bond ETFs out there that offer you that inverse exposure to bonds.
And I'm not sure, but I think that there is some instruments like CFDs that we offer on certain ETFs that can be short.
Yep, true.
So that could be an option, looking for an ETF and short the CFD.
Yep.
And then I saw another question about UK rates, where they are expected to land. That's actually a very interesting question, because when we compare what markets expect in terms of interest rate cut in Europe, in the US, and also in the UK, what is interesting there is that the UK might be just pricing quite a balanced scenario, because markets expect rates to be cut down to 3.5% by the end of 2025, which is much higher and much less cuts than what is priced in the ECB and for the Federal Reserve. So what is interesting here is that if we look at where markets estimate where rates are going to be in the UK by the end of 2025, and it is 3.5%, and then we look at the yield curve, which is basically paying 5% for 2-year gilts and 4%, not 5. 4% for 2-year gilts and 4% for 10-year gilts. The better opportunity is in the 2-year tenor, for the simple reason that if the Bank of England cuts rates to 3.5%, then the 2-year yields should follow suit and should drop towards 3.5%. The 10 years instead normally has been trading around 100 and 140 basis points over the benchmark rate. And if the benchmark rate is going to be 3 or 3.5% in the long term, we might expect the 10-year gilt yields to rise slightly above 4%. So it might not provide the same kind of opportunity that the 2-year is providing right now.
We've not got too much time left. Do you want to pick one more, and then we'll?
Yeah.
There is a question on if a perpetual bond is more risky than a bond with, a stated maturity. Let's put it like that.
Oh yeah.
Althea, you want to take that one?
Yes, well, normally perpetual bonds come in many types, and they are normally, like, the way that they are built is that they pay a fixed coupon up to a certain date, and then after that year are going to pay a variable over a benchmark. So there is that, it depends very much to which kind of a perpetual bond you are looking at. And also they have also a call option, because obviously it's unthinkable that debtor is going to be able to pay forever, perpetually, an interest rates when a market fluctuates. So the real risk of a perpetual bond is the opportunity risk if the issuer calls it back, and also, like, in case there is a step down in terms of coupon payment, because you are getting a nice chunky fixed coupon for a certain period, and then after that maybe rates have collapsed and the issuer has to pay only 50 basis points over LIBOR, for example, right? And that is going to be it's going to be a problem also for the valuation of the bond. So definitely they are interesting instruments, but they are complex and only for sophisticated investors, I would say.
Okay, so unfortunately there was no short answer to that one. It depends.
It depends on what you're looking at.
Luke, I guess we can maybe close with a question for you, which is says, good morning, good afternoon. Will we have a possibility to see record of the webinar?
Yeah, the one question I can answer. The answer is yes. There's two ways. One, the link you guys use to join this session now, that can be used to watch it on demand at any point in the future. That's one. The other method is within the platform. So there's a webinars section within the Trader Go and investor platforms. You'll find it under Discover or Inspiration. And again, you'll be able to find the recordings there, plus all our other webinars, and you can sign up to the ones that are going to follow. Just one other thing. We'll sign off in a second. I'm going to put a QR code on the screen. This one, I'll put it on. We'll say our goodbyes and I'll put it on. It will link you to a short survey, which will allow you guys to give some feedback about what you thought of today's session. And if you want to do, if you want to see any other topics in future, it's a chance to state what they might be. So if you could, it would be massively appreciated if you could just give that a scan. It'll only take you a second to fill in. But apart from that, that's a wrap. So thanks, everyone.
Thank you.
Yeah.
Thank you, everybody.
See you next time.
See you.
Bye-bye.